Okay, so we're going to do Managerial Accounting Example 6B. Please find and read and be familiar with the given data. Now what we've got here is we've got a company that produces the same number of units in 2 different years. The first year they sell less than they produce. The second year they sell more than they produce. All of their costs per unit are going to be the same, and their selling price per unit is going to be the same for the 2 years. Now you may say this is not terribly realistic, and I agree with you, it's not terribly realistic, but the purpose of this exercise is to point out how the difference between the units produced and the units sold in each year affects net income differently under full costing and variable costing. So what I don't want to do is confuse the issue or make the issue less obvious by having lots of different things change. So the only thing that's going to change is what's important to the issue, which is the sales and production volume. All right, so let's look at our requirements. The first thing we need to do is the manufacturing cost per unit under full and variable costing for each year. First, we'll do variable costing. It's the easier of the two. And in year 1, year 2. For variable costing, we're simply given the variable production cost per unit, and that's $1.80 in both years. And that's all there is. Now, obviously, in real life, it's not always going to be quite as simple as looking something up on a cost sheet, but it might be. The important thing here is that for variable costing, the manufacturing cost per unit, which is the cost that goes into inventory and also goes into cost of goods sold, only includes the variable cost. Now that's not consistent with GAAP, with generally accepted accounting principles, which requires that all costs of production, including fixed costs, be allocated to the product. So if you think about Chapter 4 and Chapter 6, or earlier modules, Module 2, I think it was, if you think about those earlier chapters, what we were doing with the overhead allocation was exactly that, getting all of the cost of production into our cost of product. Now that's required for financial statements that are going to be given externally. For internal use financial statements, GAAP doesn't really apply. We can use whatever numbers are helpful to help us make the right decision and manage the organization well. So if we want to use variable costing income statements and exclude those fixed costs from our financial statements, we can do that for internal purposes, but not for external. So for full costing, we need to include both the VC per unit and we also have to include the fixed cost, the fixed overhead cost per unit. Now, we're not going to do anything to allocate overhead cost any particular way. We're simply going to take the overhead cost and allocate it on the basis of number of units. We're going to simply divide. If you only make one unit or one kind of product, your products are all the same, this is kind of useful. Obviously, if we have lots of different units, different jobs like we had back in the job order costing chapter, we would want to do a more sophisticated approach to allocate overhead cost to products. Again, that would simply confuse the issue. So for here, we're just going to assume that total fixed cost can be divided by the number of units and not worry too much about per unit overhead cost allocation. So our fixed cost that will be allocated to each unit is $1.50. And so our total manufacturing cost per unit is going to be the $1.80 plus $1.50, or $3.30. And there we go. So that is requirement 1. What we do see is that depending on the costing method we use, we're either going to say that our units cost $1.80 per unit under VC, or under full costing, we're going to say they cost $3.30 per unit. So what does a unit cost? Depends on how we count the cost.